So this is Paul Martin with Investor Connect. Today we're here with Jeff Pomeranz of Right Side Capital. Jeff, thank you for joining us.
Thanks, Paul. I appreciate you having me on. It's always good to speak to audiences we don't necessarily get to all the time.
Well, great. Well, I first encountered Right Side Capital about 6 months ago, and a friend told me about it. And as I looked into it, it looked like it had a little bit different model for how they dealt with startups and funding and so forth. Can you tell us more about how your model is different from everyone else and what you guys invest in?
Sure. So we do exclusively pre-seed stage tech startup investing. And when you ask the question of how is it different from others, that's a big question because at virtually every level it's quite a bit different, but I can address it on a couple of themes maybe. First of all, we're addressing a segment of the market that is generally very overlooked and underserved, this so-called pre-seed stage, for the very reason that because as tech startups have continued to become more and more capital efficient, they need so little capital to get the initial versions of their products built, especially on the software side. The amount of capital has gotten so low that no real institutional body has stepped in to fill that void, unlike other times, like 5 or 7 years ago when micro VCs stepped in to fill a void that had been vacated by venture firms. But no one's done that, so it creates this big supply and demand imbalance, and we attack that, and we invest into that with virtually no competition. Now, one of the things that a model like ours requires, though, if we're going to also address the risk side of it, which we wanted to do, is large volumes of investment. So we have a strategy which will address this end of the market and do so in a high volume, systematic way. So we will do 100 plus, 150 plus now companies every year without giving up the diligence side of it. So it requires extremely efficient processes. And much like the tech startups we're investing in, we have a backbone of technology that allows us to do this. So we first of all, we're investing in an area that other people aren't. We're investing in a methodology that is really very different from a traditional venture capital methodology, and we're doing large numbers of investments there.
Well, that's great. So you do pre-seed. What are the specifics around a deal wanting to come to you and raise funding? What are the questions you're going to ask them to see if it's something you're going to pursue or not pursue? And where does it fit best? Who's an ideal candidate for you?
So to take this in a couple steps, most of the companies that come to us, and this has evolved and changed quite a bit since we started 6 years ago, frankly. 6 years ago, most of the companies that came to us were pre-revenue companies, often pre-product companies, because at the point they were looking for that first $200,000 to $500,000. That's what they were. That's still the state they were in. That's changed dramatically, so that today most companies looking for their first $200,000 to $500,000 of outside capital actually have a product built. They have initial customers. They have initial revenues. So that changes quite a bit. But what remains the same is for us is the companies usually are 2 to 5 people. They're under a year old. They have a product. They have some initial customer traction. They have some initial revenue, sometimes into the tens of thousands a month of recurring revenue. And but they need, they've moved beyond bootstrapping and some initial friends and family capital maybe to wanting to bring in $200,000, $500,000, but they're not at the state where they want to raise $1.5 million seed round, where they want to build. They've proven out the sales model, for instance, and they now want to just scale it up. They're not there yet. So that's typically what they look like. And I'm forgetting the second part of your question, though.
So who would be an ideal candidate in this case? Who's right in the sweet spot?
Yeah, so we're agnostic as to what kind of tech subsector we would be interested in. Well, as long as it's a capital efficient business model, which narrows it down some certainly, we're agnostic because we know there's no predictability into which ideas, which products are going to become the big winners down the line, which markets are going to evolve, how big those markets are going to be 5 years, 10 years from now. What we look at, though, and what we're looking for in companies is a set of characteristics, if you will, into a number of buckets. So when you look at a team of founders, we don't know if the product's going to be the next great thing or not, but we certainly want a team that has the technical skill sets to get it built properly and adapt to customer feedback and make the changes and pivot if necessary. We want a team that has the domain expertise in the areas that they're looking to build a product into. If it's an enterprise company, it would be wonderful if someone on the team's got some enterprise sales experience, et cetera. So you get the idea. These are all characteristics that you can quantify. Secondly, there's a body of data we were going to look at into the business model, the capital needs, and the capital efficiency of that company. We want companies with greater survivability. Survivability is critical at this stage because companies need time to figure things out, figure out what product fits the best, and that time is a function of capital, and that's capital efficiency leads to a greater survivability. And thirdly, a much more dominant set of factors today, which we didn't have as much to lean on 5-6 years ago, is traction. So you have a lot of data now we can look at when they have a product. They have month-over-month revenue numbers, KPIs, and all of the other factors relating to their business that we can identify and look at and see not only what absolute revenue they're at, but what slope of revenue growth they have and other factors that are important. And we combine that as a whole. We take those three bodies of data and roll them into what we think of as a profile of an ideal startup, as opposed to trying to pick themes and pretend we have a crystal ball.
And what kind of month-over-month or quarter-over-quarter growth rates are you looking for? What's a minimum or what's an average that you think this is good for us, and below that it's not?
Yeah, it's a tough question to answer because it's going to be very different depending on what industries they're in and how far along they are. So there's no magic number there, but we see, I guess, not to be overly simplistic, but the greater the growth, the better. So if we're seeing a company that's gone from next to zero revenue 6 months later to doing $20,000 a month of revenue, that means something very important to us. So it's not the percentage month over month, because at this stage, going from zero to something, the percentages just don't work, as opposed to something that might be just incrementally growing at 10% month over month. It depends on the business and where they're at.
And what about different sectors? Obviously, you're in software, mobile, and that type of thing, but what about medical device or hardware-specific deals? How far out do you go in those directions?
We will be open to any of those sectors. Again, the criteria for us is it a capital-efficient business? So it becomes harder and more uncommon for us to do anything in hardware or material science, certainly not life science. Anything with a physical good is more difficult for us to do, but we will be open to looking at it. If it is truly capital efficient, we will be open to looking. It just becomes very rare that we will pull the trigger on something like that.
And so how many deals have you guys done on this fund or this year, or whatever metric might be most relevant here?
Yeah, so we started investing in the beginning of 2012. In that year, I think we did something like 70 companies. And now we've grown to, in this past year, in 2016, we did something around 180 companies. All told, we're pushing close to 700 companies in total now.
And as a message to LPs out there investing in these funds, what would you say is the advantage of your model over a traditional VC model where they invest much later and more traction-oriented deals? Yeah,
so it's not – the VC model has a lot of good reasons for it when applied to those later stages. I'm not trying to say that model is no good. However, it doesn't work well when you're going down to trying to write $100,000 checks at a company only looking for $300,000. It does not work as well there. The advantages from an investor's perspective of whether you're an angel investor or someone that is not looking to do any individual angel investments like that is we become a way to get exposure into the high performing segment that we're addressing, but do it in a way that protects against that downside risk that you have, because any individual company has, the most likely scenario is it's not going to work and you're going to lose all your money. However, when you roll up 500 of them in one fund, you now have a great return with a protected downside.
And do you have any experience with follow-on fundings, or is it purely a one-shot deal?
For us, we, by mandate in the strategy, we do not do any follow-on funding. Without getting into the details of it, the simple reason is it's dilutive to performance as a whole. The most important reason there is just the negative signaling on all those companies that we might not be participating in. It just doesn't work when you have hundreds of companies. It's not that, people ask us all the time, don't you see companies that are absolutely a no-brainer and you want to back up the truck? And the answer is yes, we do. The problem is not that individual company might not have a great expected return for us, which it would. The problem is the negative signal it sends to those companies we're not necessarily investing in their next round, and the negative signal that sends to all the potential investors looking at their round they are raising. So what we've chosen to do is simply take those opportunities while we're not cutting the check ourselves. We bring them to our LP base, and very often they're participating in those deals directly.
Okay. Well, given the number of deals, obviously you can't spend a tremendous amount of time with each and every portfolio company, but what can you do for those portfolios in addition to the dollars you write?
Yeah, it's a good point you bring up. Clearly, we're not taking 700 board seats, but you can be extremely impactful to companies when you're dealing at this stage. Remember, when you talk about impact, it's compared to what, and at this stage, we in most cases, we are the most impactful investor they have at that time, because most of the investors they have are friends, family, and a few angels, and it's not that some of those people can't bring real value, but rarely is there an institution that can bring the kind of value we can and impact, and that, think of it as best to think of it as where heavy mentors for companies that where we step in at catalyst periods of time, whether that be their next funding round and we help them think it through and help them network to a great body of next round funders, or it might be that they've just gotten a call from one of their customers or business partnerships that's interested in buying them, and all of a sudden they need to think about whether an acquisition would make sense at the stage they're at, and we help them through that process. But we're not involved in the day-to-day micromanagement of thinking through what their product roadmap is over the next 2 years or something like that.
Right. Well, how do you handle the valuation and the pricing mechanisms? I assume these are not convertible notes; they're priced rounds, and it seems like you might have some standard metrics around that. Yeah,
again, that has evolved, and it has changed, interestingly, very dramatically, and much more than we anticipated over the past 6 years since we started, and in the opposite direction that later venture has enjoyed. So whether it's seed, A, B rounds, over the past 5 years, have certainly seen a dramatic rise in average valuation. We have seen the opposite happen, where the valuations we have seen at the pre-seed stage have gone down every year, and much more than we anticipated. And that's because of the supply and demand again. More companies than ever looking for small rounds of serial funding, and no one's really offering capital because it doesn't work for those firms to write $100,000 checks again. They don't want to pay attention to it. So that's been a very, it's obviously been of great benefit for us because we're getting companies with greater progress at a lower valuation.
Well, that makes sense. If you get to $5 million of revenue, everybody wants to be in that deal, and so valuations get bid up. In the very, very early stage, there's not nearly as many people in the room, and so therefore valuations get bid down. And so it seems like that's a great spot to be as far as getting good valuations on early deals.
Yeah, and it's more a matter of not the traction they have, but the amount of capital they need. Once a company is at the state where they want to raise a $1 to $2 million round and above, a so-called seed round or above, there are lots of investors out there that will address that need, the so-called micro VC space and beyond. The problem is anything underneath that, if the company only wants $400,000, regardless of whether they're at $20,000 or $60,000 a month of recurring revenue, that gets a lot less attention. And people that are willing to step in there have the benefit of very little competition when it comes to setting terms and valuation.
And where do you find most of your deal flow? Are they just showing up on your doorstep through word of mouth, or are you out and about in the accelerators and other places getting the word out on your opportunities?
Both, really. Today, certainly the number one place where most deal flow comes from is our ever-growing body of founders that we have in our portfolio or engaged with that over the years have, they're operating out of startup ecosystems now, like startup workspaces, and they're in and amongst other founders. So we're getting companies referred to us all the time. So that's certainly the number one place. And when you do that, it's an exponential sort of growth curve there now that we have, against probably 1,500 plus founders in our portfolio. That spreads very quickly. And then secondly, yes, for many of the same reasons we have evolved to be able to do what we do, the accelerators have exploded onto the map as well. And those are great ecosystems for us to engage with and find the founders in large numbers that we can leverage off of those systems.
Well, that's a great model, very unique model, and certainly one needed. Price rounds at that early stage, institutional funding at that level is very rare and also very valuable, which is why I guess many entrepreneurs look for that to get validation for their business as they go out to other investors and grow their business. But with 1,500 past funded deals, you have your own entrepreneur ecosystem there. What's the next step for you guys and those 1,500?
Yeah, and just to clarify, we might have 1,500 founders, but it's 650 to 700 individual companies. Still large, but I just wanted to clarify that. So
sure.
Next steps for us is continue to grow. We're at 6 years in. We're still a young firm. We now have enough history and track record where people can see how the model works and see that it is working and actually doing better now even than when we first started, because it continues to get to be a better place. And we want to, as we originally set out to, we want to be a factor that can dramatically impact in a positive way the entire startup ecosystem for young startups to be able to get the capital they need at an early state where they only need a small amount of capital, because it's always been such a dysfunctional and fragmented end of the market. We're creating greater efficiencies there and impacting it in a very positive way.
Well, that's great. That's great. Well, I appreciate your taking time and sharing this information with us, and hope to have you back in the near future to go into more detailed topics. Is there anything else you want to share with the group?
No, I appreciate you taking the time, Hall, and we're always happy to get on the phone again.
And what's the best way for people to get in touch with you? LinkedIn profile or other?
Well, our website certainly has all of our information there, and people are welcome to reach out. Founders are guided through our site to be able to submit data and reach out to us. And our LinkedIn profiles are all publicly out there. And like many others, people can reach out to us every day.
Well, great. We'll put that in the show notes so people can reach out to you. I'm sure they'll find you through the website primarily, but it's good to know who's on the team as well. But appreciate your taking time, and we'll let you get back to work, and we'll go from there. Thank you so much.
Thank you all.